Welcome everybody to today's webinar on how the $3 million Div 296 tax will impact self-managed superannuation funds. Now, this is quite an interesting subject matter. I've been talking about it now for nearly 12 months, and of course we got to the end of last year, and we saw a fair bit of movement with regards to the government from an introductory point of view, from a legislation piece. But also, we've seen a lot of commentary in regards to this piece of legislation. So I think now that we've got legislation, it's certainly worthwhile working through some of the key issues associated with the legislation and how it's going to apply and how it's going to impact self-managed superannuation funds. So that is really what I intend to work through with you today. So I'm going to touch on how the earnings are calculated. So there's basically three calculations that are required for Div 296. So I'll work through those with you today. I'll touch on the concept of total superannuation balance, because one of the key issues with regards to the legislation is that it's going to introduce a new definition as such of total superannuation balance. So we need to sort of be ready and prepared for what that means from our, I guess, reporting point of view, but also maintaining records on behalf of clients. And then, I want to touch on through my discussions, particularly around contributions and withdrawals, which form a big part of this legislation, how various life events are going to impact. And, I've incorporated the 3 Ds there of divorce and disablement and death, and there's clearly many other events as well, but the death one leads naturally on to the question, which is always a question that I'm ready to trigger a conversation on, which is the whole discretionary versus reversionary pension. So I think Div 296 sort of brings us into line with more conversations around one versus the other with regards to discretionary and reversionary. And again, it's not necessarily a situation where change is inevitable for clients, and I would never suggest that people need to go one way or another, because they're always going to look at their own circumstances, and their circumstances will dictate whether or not they can even be close to the $3 million. So again, it's not panic stations for all. It's just a conversation piece around what those with higher balances might be contemplating, particularly if there's insurance involved in their superannuation fund. I'm not one to suggest that there's a lot to be done in the space of contribution strategies with regards to Div 296, because primarily, and I say primarily, but most people that are impacted by Div 296 don't ultimately have the capacity to make non-concessional contributions as such. But certainly things like downsizer contributions and CGT, small business contributions, where you've got no link to the total super balance, then clients will need to look at whether or not there's benefit in putting that money into the superannuation system. But that's all going to be linked to lots of ongoing discussions, particularly in light of stage 3 tax cut changes and changes to thresholds there. So everything's intricately linked. And how we discuss these matters with our clients are going to be fairly important. So, of course, a lot of that leads to what our learning outcomes are for today. So let's jump straight into it. And what I wanted to start with regards to the whole Division 296 is a little bit of a timeline, just to give you a bit of a sense as to what's occurred over the last effectively 12 months and where we're sitting now with reference to the legislation. So, what we know is that the government made an announcement, and for those that maybe go to things like the SMSF Association conference and other things, there was a lot of rumblings around this time last year in light of the Objective of Super announcement, which was made in January 2023. There was a lot of conversation around, that the government were going to target high balance members. And of course, one of the rumours that were going around at the time was that people would have to take their money out of super if they had more than a particular balance. course, there was all sorts of speculation as to whether that balance was 5 million or 3 million or whatever it may have been. But there was all sorts of rumblings going on about what was going to be introduced. And that effectively came to a head on the 28th of Feb last year, when the government announced that there'd be this additional 15% tax on high balances from a superannuation point of view. Now, that was the initial announcement, and clearly we didn't really understand what that meant with reference to how it would apply. And we got greater insight in that on the 31st of March, when they released their better targeted super concessions. And they released that with a consultation period of 2.5 weeks. Now, 2.5 weeks happened to fall over Easter as well, so it didn't particularly give the broader superannuation industry a lot of time to respond. You'll see there that I was actually involved in some Treasury and SMSF Association roundtable discussions pretty much on the final days of that consultation period. And what was pretty interesting in that consultation was that it didn't feel so much like a consultation. It felt like we have to give the industry a voice, but we're not necessarily going to pay heed to anything that they raise, because the conversation effectively started with, thanks for your time today. Just to be clear, the tax offer, or not the tax offer, sorry, Treasury are not too keen on changing the threshold, and they're not too keen on changing the way that earnings are calculated, but we're interested to hear any other feedback you might have. So, well, that's ultimately all the feedback that we want to give. So we could be banging our head against a wall. Needless to say, we got the federal budget announcement confirming the introduction. We then had our exposure draft legislation come out at the start of October, again with only a short consultation period, this time 2 weeks. And following that consultation, we then saw the introduction of the bill on the 30th of November. Now, ultimately, the introduction of the bill saw very little change from what was introduced back in March and subsequently as part of the federal budget. So, a lot of the issues haven't necessarily been addressed, or at least necessarily been addressed to the level that, as an industry or as a sector, we would like to see. But of course, we have to move forward based on the assumption that what they have prepared and provided is how we're going to, or how this is going to be enacted. And the only hope, the potential hope, is that it's currently stalled in the sense that it's been referred to a Senate committee for review, and that ultimately gives a greater consultation opportunity for those that have something to say to talk to other senators. And I'll touch on that a little bit later on in the presentation. So that's kind of a state of play as to what and where we've got to with regards to this Div 296. But I think as a lot of you are here to find out the ins and outs of how it operates, I want to start to work through some of those key issues. Now, one of the things that has come about from it is that we have some more superannuation acronyms, which is always great to get additional acronyms to work our way through. So we obviously have TSE, or taxable superannuation earnings, and we've got the scenario now. We've got that is ultimately the first calculation that we have to do. So we do a 3-step calculation. We calculate our taxable superannuation earnings, then we calculate the proportion of those of the earnings that represents the earnings above the balance of $3 million. And I'll talk a little bit about the large superannuation balance as we go through the presentation. And then we touch with the final step, which is the taxation liability, which is 15% on that proportion of the earnings that represents the proportion above the 3 million. So there's 3 distinct calculations, 2 that can add a bit of confusion because they're all around the concept of total superannuation balance, but they adopt different concepts and they adopt different versions of calculations of total superannuation balance to determine, firstly, what the earnings are, and secondly, what the proportion is. So You know, I mean, in an industry, and for those of you that have been in the industry as long as myself, you know, there was a time, and that time was 15, 16 years ago, when the government said, let's simplify superannuation. Well, I think those dreams certainly went out the window when the legislation to simplify superannuation actually made it far more complex anyhow. So, you know, I'll jump off that bandwagon now and start working through some of these calculations. But as I said, one of the first things that we note now is we've got this other concept, which is the LSB, or the large superannuation balance. So this is this $300 million threshold. The concept at this stage is that won't be indexed. Obviously, that's part of the conversation that industry has been having, is that, you know, we talk about how many people are impacted by that $3 million threshold now versus how many people will be impacted by that $3 million threshold in the future, when we have potentially higher balances with regards to movement in fund earnings and investment returns. Now, the flip side of that is that, you know, is there some scope to suggest that this measure is jumping at shadows, because we've now got and now had in place for however many years, if you go back to 2007, contribution caps, which restrict how much can be put into super. And then beyond, obviously, 2017, where we saw the introduction of the transfer balance cap, that restricts our capacity to make non-concessional contributions, subject to how much money we have in super. Now, of course, this is the catch-22, is that the transfer balance cap, the general transfer balance cap at the minute, is $1.9 million, not being indexed this year. So we'll remain at 1.9. But of course, by the time this measure comes in, so 30 June 2025, this measure comes in, you can almost put your money on, although I don't advocate that, but you could almost suggest that we're very, very close to the general transfer balance cap being indexed to $2 million next year, so the 25 year. So, you know, it's not going to take a long time until people are still going to be able to make non-concessional contributions and have close to that $3 million purely from an indexation point of view. So anyhow, our first step is to calculate the earnings, and then it's to calculate the proportion. So let's start to work through some of the key concepts here. As always, the slides will be made available to you after, so you can work through both the calculations and the examples that I'm going to go through with you today. So the first key issue is total superannuation balance. And of course, this is what's central to the concept of Division 296. And I guess it's what, in many respects, makes it quite divisive, because we're talking about earnings based on an opening balance and a closing balance. But those opening and closing balances, and this won't be the first and only time I say it today, will be the first time but not the only time I say it today, opening and closing balances obviously is recognised as unrealised capital gains. So that's kind of where the primary concern is raised from industry, is that we are basing an earnings and basing a tax on an earnings on paper-based earnings, not on realised earnings. And I think that for many is quite problematic. It should be for most, if not all, a problematic element of this legislation. So we've got to think about what total superannuation balance is. So it's going to be relevant for the percentage of earnings above that $3 million, as I alluded to before. We are calculating those earnings with reference to our total super balance at the start of the year and at the end of the year, with an adjustment made for withdrawals and contributions. So again, complexities associated with that. Timing of withdrawals and contributions are not taken into consideration. So again, it's going to require more accurate sort of reporting. Now, most people report obviously withdrawals and contributions via the annual return, but you know, where things sit, such as the use of contribution reserves and other things like that, a lot of that sort of stuff I think has to play out in a practical sense, but just be mindful that we've got this capacity to adjust, and that's going to be important from a strategic point of view. But also, what we get out of this is a new concept of total superannuation balance. So whereas the total superannuation balance has always been linked to your personal transfer balance cap in many respects, and the general transfer balance cap, we now are going to see a removal of that. So it simplifies the calculation of total superannuation balance, but it also does something else, which is it means we end up with two different reasons to make or to utilize the total superannuation balance, or to calculate the total superannuation balance. And again, that's problematic where you're looking at the same concept with different outcomes for different reasons. It just adds to the level of complexity. So to give you an example of that, we've got our existing total super balance calculation, which is the calculation of our accumulation phase value. So at 30 June, what would we have if we were to take our money out there, plus our retirement phase value with adjustments made or modifications made subject to our transfer balance cap. So that's an overly complex calculation, which ultimately in almost all circumstances results in just looking at what the actual value is at 30th of June if you were to pull your money out at that date. So that's the current calculation. You've also got your rollovers, you've also got certain outstanding limited recourse borrowing amounts, and then you take off your structured settlement contributions. So from the 30th of June 2025, the proposed change is to include both the accumulation phase and the retirement phase values based on if your fund closed down on the 30th of June. So we take out that reference, the linking to certain debits and credits in the transfer balance account, and make it more about what the actual account balance is, which is certainly in a more appropriate way to calculate total super balance anyhow. Obviously incorporates certain death benefit income streams. From a timing point of view, that becomes relevant with regards to reversionary versus non-reversionary. And then there's going to be some regulatory change around defined benefit interest. So that impacts, of course, self-managed super funds that might still have lifetime compliant pensions in their fund. And so again, a measure like this, for someone like myself who's been working in this space for a while, to me, it puts a little bit more pressure on the government to finalise their position about legacy pensions inside self-managed superannuation funds and the ability to effectively create an amnesty to unwind them. So hopefully we see some activity in that space this year. We will get our in-transit rollovers. We will still take out our structured settlement contributions, but the kicker or the big difference is for Div 296 purposes only, we will remove those outstanding limited recourse borrowing amounts. So the proportion of the LRBAs that were effectively entered into after 1 July 2018, where the members either met a condition of release or it's a related party loan. Now, given that the likelihood is that the majority of individuals that this will impact will be those that are closer to the retirement phase, then arguably, and most of those LRBAs, those related party, any LRBAs, those members will have met a condition of release, and so it would add some complexity to the calculation. So the removal of that is a positive step, but again, what it means is that total super balance is going to be calculated differently for two different measures. So that's the calculation of total super balance, and then what we have to do is we have to then apply that to our method for calculating the earnings, and that calculation of the earnings takes us down another path, and that is to calculate the current adjusted total superannuation balance. So the earnings is based on your total super balance at the previous year. So we take what the balance is at 30 June. You then apply what they call a current adjusted total superannuation balance at the end of the year, and that is the total super balance at the end of the year, plus withdrawals made for the year, less net contributions made for the year. So what we're actually ultimately doing is saying, what's your start rate, what's your end rate, right, and what adjustments do we need to make at the end, right, to take into consideration various contributions and withdrawals that were made through the year. Now, of course, this is not our calculation to make. So this is not something that we have to make as SMSF professionals. So the ATO will be making these calculations based on the information that's reported to them, and that information is being reported across the broad spectrum of all superannuation funds, remembering that this is ultimately a tax on the individual, not a tax on the super fund. So it's going to be the collection of data that's being provided by all the super funds to the ATO based on that individual, and then determining whether or not the tax is going to apply. So we then, so as I said, we have this concept of current adjusted total superannuation balance, which makes allowances for adding back withdrawals and taking out net contributions. So what we then have to do is we have to understand what is counted as a withdrawal and what's not counted as a withdrawal, so we know what we're going to be adding back in. And this is where we start to consider some of those key issues that I talked about with the 3Ds of super: death, divorce, and disablement, because some of the withdrawals in that are linked often to those style events in the SMSF space, amongst other things. But the withdrawals that we will add back in are going to be our standard benefit payments, so whether they're lump sum or pension, right? So again, whether so in one land you're making decisions about whether something's a pension or a lump sum for transfer of balance cap purposes, but in the scope of Div 296, nobody cares, right? It doesn't matter whether it's a lump sum or a pension. It's all going to count as a withdrawal. Any contribution splitting amount, so any amount paid to the spouse, which is ultimately a rollover, but that's a withdrawal that will be added back in. Family law splitting payments. So if you make the payment to the spouse, so the withdrawal from the one party to the other party. So again, in the SMSF space, often you'll see that transaction happen in 1 year, and then the next transaction, the rollover out of the fund, might occur in the next year. So that's going to get a little bit clunky from the timing of withdrawals and contributions in that regard. But again, where I come back to this being problematic is that it doesn't take into consideration at what time of year the family law split occurs. And so, you know, inevitably for somebody, if the court orders go through and suggest that the payment split must occur, 4 business days from the operating time, and that operating time happens to be the start of the financial year, then despite you ultimately never having the money in the superannuation fund, it gets added back in. So that's going to be, to me, it's one of those sorts of timing-based calculations that's slightly problematic. And there's a few other ones: amounts withheld from excess untaxed rollovers, amounts released under a valid requested release authority, any amounts prescribed by the regulations. Those instances always worry me a little bit. And then first home super saver valid release authorities using a formula. Now, something to highlight here, and I do sort of try to pick the bones out of where I see the problems arising in these pieces of legislation. Also the positive, but primarily I look for where there are issues. Now, that first home super saver valid release authority with a formula is quite an interesting measure, because what they're basically saying is that when you release money under a valid first home super saver scheme, firstly, let's be clear, most people who have more than $3 million inside a super probably already have a house. I might be sounding a little bit cynical there. They probably have already applied for and had their first home many years ago, so they're unlikely to be withdrawing money under the first home saver super saver scheme. But this formula that's being introduced is being introduced to say, okay, well, when you take money out under the FHSSS, you get associated earnings and they're taxed in your tax return. What this formula will do, it will remove, effectively make an adjustment for those associated earnings. Now, my problem is not with that. My problem is that the other release authorities that we're talking about, you've got your Div 293 release authorities, you've got your excess concessional contribution release authorities, and then you have excess non-concessional contribution release authorities, which are almost exclusively about removing the non-concessional contribution and an amount of associated earnings, right? And that amount of associated earnings is then taxed at your marginal tax rate. So the release authority that is going to relate far more prominently to members with more than $3 million is excess non-concessional contributions rather than first home super saver scheme. And to not make an allowance, right, at least in the initial legislation, to not make an allowance for the associated earnings that is released with regard to that, and therefore to have to add that amount back in and count it towards an earning is, to me, that's a huge issue that that the industry as a whole needs to be pushing back on the government for. So it's one of those things that that I think we need to make a lot of noise about. What's not a withdrawal or rollover superannuation benefits, except contribution splittings, but let's not split hairs there. Continuous disability policy payments, withdrawals arising due to fraud and dishonesty, unclaimed money, act amounts paid from foreign super funds. So if you've got your money inside a super overseas, you take that money out, it doesn't count. And then amounts prescribed in the regulations. So again, one of the things that we do a lot of in self-managed super space is rollovers or transfers of foreign super amounts. So one of the things that I guess will now move into the planning space is if you've got clients with money overseas and they're saying, I'd like to bring that money into my self-managed superannuation fund, then it's got to weigh up as, okay, well, will that money combined with whatever money in Australia, will that push you or you and your spouse towards having more than $3 million inside super in Australia? If so, is it worth bringing that money to Australia? What are the tax considerations of that money staying where it is? So I think the whole concept of foreign super is one that we need to be mindful of. So that's the withdrawal side of things, which I think is important to note. Then on the other side of it, we've got the contributions. Now, key here is it's only 85% of concessional contribution, so it is a net contribution amount there. But then you've got your downsizer and your CGT cap amounts. There's an exclusion for the structured settlement. But one of the things is, again, is because what we're doing is we're taking these out, it means you're getting effectively 1 year's worth of grace before that amount, if it remains in super, will be counted towards the earnings amount. Contribution splitting amounts, so amounts received from the spouse, family law splitting payments. Again, so the receiving spouse doesn't count it in year one, the paying spouse counts it in year one, the receiving spouse will count it in year two. Total super balance, which again, what it highlights is that, okay, well, that money was earnings for one person and that person's being taxed on it, and then it's going to move to another person, so we're going to tax it again in that person's hands the year after. So, is that right or wrong? According to Treasury, it's right. Total super balance value of death benefit income streams. So again, we've got to, if we pay commence a death benefit income stream with a new member, we subtract that in the first year. So that's something that's important to note, is that the commencement of the pension doesn't count in year one. And as I said, I will come back and talk about discretionary versus reversionary pensions at the end. Amounts allocated from reserves, so certain amounts allocated from reserves count there. I think we've got some other work to be done in that space. Transfers from a super fund, so it gets subtracted in that first year, but then will count afterwards. Then you've got some remediation payments and any amounts prescribed by the regulation. And the one that I skipped over there is the one that I wanted to talk about probably the most, is death or TPD insurance proceeds. Now, death proceeds obviously are not going to impact the member who has passed away, because one of the exceptions to Div 296 is if you die during the year, then effectively any Div 296 liability is not raised against you. So any death proceeds will clearly form part of any death benefit income stream that is commenced for the surviving spouse. So they'll come in and be factored into that whole plus and minus with regards to death benefit income streams. But TPD insurance proceeds is, again, one of those ones where, for me, there is an exclusion, as is the case in many instances, and rightly so, for structured settlement payments, saying that these payments are being made based on circumstances where individuals can't work anymore, and that compensation payment is obviously to help them through the remainder of their life. The only difference with TPD is that it's being sourced not through the courts, but through an insurance policy, yet we are counting TPD policies with regards to not the first year, but then the second year as being counted against the member's balance. And so ultimately, the same person or a different person in the same set of circumstances where they're unable to work because of their injury or illness, if they get a structured settlement payment, they're excluded from Div 296. If they get a TPD payment into their superannuation fund, then they're going to be included from a calculation point of view if they're over that $3 million. So again, anomalies, different anomalies that apply based on individual circumstances, and that's a little worrying for me, and certainly one of the issues that we raised at that early consultation period. The ones that I jump on my soapbox about today are certainly issues that we have raised with Treasury in regards to this legislation, and hopefully through the final consultation with other parties that we can potentially get some changes made. What's not a contribution? Rollovers, contributions to foreign funds, any amounts received under the Unclaimed Money Act, and any amounts prescribed by the regulations. So we have to factor all of these sorts of things in to the first calculation of the current adjusted total superannuation balance to determine what our earnings are. So let's have a look at an example so we can work out what those earnings are. So we've got Jan, who's a member of a self-managed superannuation fund. At 30 June 2025, her total super balance is $4 million, right? So comfortable that she's over that $3 million there. During the 25-26 year, she made $27,500 of concessional contributions. She made $300,000 as a downsizer contribution. Clearly can't make non-concessionals because she's got more than $1.9 million, and took out $150,000 in pension payments. And at the 30th of June 2026, her total super balance is $4.5 million. So what we need to know is, how does the legislation apply to Jan? So what we've got is, we've got our $3 million threshold sitting there, and we start with a total super balance of 4 million, and we end with a total super balance of 4.5 million. But we have to make our adjusted total super balance calculation, so we have to add back the $150,000 on behalf of Jan. We then have to take out 85% of the 27,500, which is 23,375, and we have to take out the $300,000 downsizer contribution, meaning that her adjusted total superannuation balance as of the 30 June 2026 is 432,625, meaning that her earnings, which is the difference of the current adjusted total super balance less the previous total super balance, is 432,625. Take $4 million, gives us a total earnings amount of 326,625. So that's the first calculation that has to be done in all instances. If the total super balance at the start of the year and the total super balance at the end of the year are less than $3 million, then we don't make the calculation. If the total super balance, the standard total super balance, is more than 3 million at either one or the other, so at the start or the end, then what they do from an earnings point of view, so if you've got a situation where somebody has more than 3 million at the end, but they had less than 3 million at the start, then we effectively also make an adjustment to that starting figure or that ending figure to cap it at $3 million. So when we're talking about the earnings, we're only trying to calculate the earnings above that $3 million mark. So if you started with 2.5 and ended with 3.5, you're not doing a calculation on $1 million, you're doing a proportionate index calculation on 500, which is the difference between 3.5 and 3. A little bit complex, but it's just one of the things to take into consideration. So that's the earnings calculation. So then we have to determine how to calculate the tax. So we know that Jan has a total super balance which is greater than the large super balance threshold of 3 million, and her super earnings are greater than nil. Right? And that's relevant because we'll talk about if it's below nil in a moment, which means she'll have taxable super earnings for Div 296 purposes under the Act. How much will she have? Well, what she'll have is that $300,000 that we've calculated before, and then we have to work out the proportion of that above 3 million. And in this calculation, we don't do it based on the current adjusted total superannuation balance. We do it based on the total superannuation balance. So in this instance here, we have the 4.5, which is her ending balance, right? We subtract from that the $3 million threshold. So we look at the earnings above that, and we then divide it by the total superannuation balance, which in Jan's case gives us a percentage of 33.33%. We then apply that taxable super earnings to that 33.33% from a proportion point of view, means that the proportion of the earnings above 3 million that represents that effective piece, that piece of what has been earned, not on the first three, but on the amounts above 3, represents 108,864. So we've got 326 million. We know that some of that, 326,000. We know that some of that's there because we had that first 3 million, which is exempt from it. So only the 108,864 is taxable. I say only, it's still significant, and that is taxable at 15%. So Jan is going to get a tax liability of $16,330. Now, one of the pieces that comes out of this is that the conversation comes back to, okay, well, is our money better inside or outside of superannuation? Now, I suspect that over the next 12 months or sooner or later, depending on when the legislation actually gets finalised, we will see a lot more people starting to give thoughts and calculations and all sorts of things and strategies around the considerations of money inside or outside of superannuation. But just to give, I guess, a bit of an example, and I think the stage 3 tax cuts are also going to influence this conversation as well. But if we move that $1.5 million out of super and into the Jan's personal name, remembering that that was one of the rumoured thought processes back in February 2023, was everyone thought maybe we'd have to take the amount out of super. But a positive, potentially a positive, is that money can stay in the super environment. So if that $1.5 million comes out of super, goes into Jan's personal name, and let's say it earns 5% interest, so we've got $75,000 at 30% tax rate. Right now, again, with the new tax rates, if we're looking at 135,000, let's wait for all that to be finalised. It's giving us additional tax liability of $22,500 versus the $16,000 that's being paid in the super fund. Our unrealised gains are not going to be taxed until sold, but they're going to be taxed again at that marginal tax rate, even take into consideration the 50% discount. Versus that money sitting inside of self-managed super fund, where the maximum tax you're going to pay on any assets held longer than 12 months is going to be 10%. But for the vast majority, they're going to be in at least some part pension phase. So there will be proportionately less tax to pay, given that they'll have their ECPI amount as well. So, there will be this point, and we'll call it obviously our break-even point, where tax inside versus outside super is better. But I think what people, particularly those in and around the $3 million mark, have to contemplate is, let's not jump at shadows and pull our money out of the super environment because there's an additional tax to apply, because that additional tax may still apply on the outside at a different rate and at a higher rate based on what other investments you hold. And if we factor in that most people with more than $3 million don't just have $3 million in super, they've got money outside of super via multiple other sources. And so, they're actually spreading their tax liability across a number of entities. So I think there's a lot to play out in that space there. And of course, in the SMSF space, you might have franking credits and other things that are offsetting and reducing the fund's tax liability. So the overall tax position may be better. So I think it's one of the things to certainly be mindful of in regards to how and when and how much tax is going to be paid if the money's sitting outside of super. So as I said before, this is an individual tax liability. It's not a super fund liability. There are certain exceptions. Now, again, a piece of legislation maybe gets changed, hopefully gets changed. We do have an exception for child recipients of pensions under at the end of the income year. So similarly to the modified transfer balance cap. So when a pension is paid to a child, we have an exception to say that child won't be eligible or subject to the tax. Now, again, I would argue in that situation that there's not a lot of child pensions where they'll have more than $3 million. I mean, you'd have to be a fairly unlucky set of circumstances where you've got two parents, both with more than $1.5 million in pension or in accumulation each, and a single child who's under 18 and has both parents passing away, and ultimately ends up with that money received as a pension and having that $3 million. It's going to be a fairly rare set of circumstances where that applies, but yeah, at this point in time, that's one of the exceptions. Just a question that's jumped up for me here: how many people roughly are expecting to be impacted by this 3 million total super balance? Well, the government's numbers, the figures that they've indicated to this point is about 88,000. I think was the number that I heard sort of pushed around, and I think in theory that's forecasting movement in balances from when it was announced to right up to 30 June 2025. But I'm not really sure that that's where we'll end up. And again, there's obviously a lot of people that say that it'll be a lot more people that will be impacted, and there'll be others that suggest there'll be a lot less that are being impacted. And I think one of the key things that I'm going to talk about in a moment is those that are being impacted by it, that it's a problem for, because the industry as a whole is not necessarily argumentative with the idea of people with more money in super can have a higher tax liability, and there's been all sorts of discussions about that over the last 20 years. It's more the mechanism and the unrealised capital gains tax element that is certainly something to consider. So structured settlement people contributions are excluded as well. And then this one here, which I think is a piece of badly worded legislation, among some other badly worded pieces of legislation, and that is individuals who have died before the last day of the income year. So, you know, I make this comment in jest a bit, but it means that if you die on the 30th of June, that you would still be liable for Div 296 if you had more than $3 million. But if you died on the 29th of June or before, then you are excluded from the amount. So, you know, whether we'll see a legislative change that says someone that's died prior to the first day of the following year, time will tell there. The tax is payable 84 days after the Commission issues a notice. So we do have a longer time frame comparative to something like Div 293. And the general interest charge rate is lower as well. So it's about 4% lower than the standard rate. So there's a number of things that benefit out of that. The individual can, so when you get your assessment, I'm not suggesting those online are going to get the assessment, but when clients get the assessment, they can pay it personally or release it from the super fund, and the super fund's got 60 days to do it. And you can choose which interest it comes from. So again, it comes down to, similar to other release authorities, whether you take it out of pension, accumulation, tax-free, taxable, all those sorts of things will come into consideration. What the SMSF Association have focused on, as far as not the entirety of their roundtable discussions and submissions to the government, but they've highlighted, and there's a fair anomaly in the statistics that get provided by different parties, and of course there's always different vested interests. But one of the things that they've said is that there's a significant proportion of self-managed super funds with high balances that own such things as farming land or primary production from a business real property point of view, and that's going to create potential cash flow issues, but also that these assets are capital assets, not income assets, in regards to the fact that, you know, they have reasonable capital return, but that's unrealized at this point in time, and they don't have the liquidity to be able to pay out the liability. And so, you know, that's one of the pieces, but the broader piece being that how this legislation impacts those with property inside a super from a point of view of generating tax on that asset that hasn't been sold is largely problematic. And the other piece to that, and just using startups as the example there, is that there can be an early valuation increase, and it creates this concept of paper profits, but they don't always eventuate. And, you know, I mean, a lot of self-managed super funds that jump into these styles of investments do so with the hope that these investments will bring them a small fortune. And for those of us that have been in the industry long enough, will appreciate that that isn't always the case. And so you may be paying tax on an investment that ultimately pushed you above that $3 million. But then when you eventually sell it, so you get that tax liability, and then when you eventually sell it, the asset drops back down below the $3 million mark, and the total value drops down below the $3 million. You've paid the tax, but you've got no way of getting any benefit out of the losses that are created in the super fund environment. So it's a matter again that the industry is hot on from a discussion piece. One of the questions that's come through there from Rowan: is there an advantage in valuing farmland high at the 30th of June 2025? Well, look, it's a bit of a catch-22. I've always, in this instance, with that sort of question, Rowan, trying to work out. Firstly, you've got your valuation requirements. So obviously, you've got your audit requirements from a valuation point of view. Now, the issue with valuing it high is, will that trigger you to be over $3 million at 30 June 2025 and automatically in the realms of this Div 296, and then subsequently in following years there maybe not be so many valuation increases or something which potentially mean that you've triggered a liability that you otherwise wouldn't have if you'd valued slightly at the lower end of the scale, particularly for those in and around the $3 million mark. So, I don't want to jump too early on the valuation element, but it's clearly going to become a valuation issue for a lot of people to contemplate. So if we look at the taxation position and we move forward 12 months, so now at 30 June 2026, we knew that Jan's total super balance was 4.5. During the 26-27 year, made 30,000 concessional contributions and 200,000 in pension payments, and a total super balance the following year was 4.2 million. So what happens there? So in this instance, again, we go through all of the same calculations that we did for Jan the first time around, but we know that now her adjusted total super balance is, when we add back the withdrawals of the pensions and take out the smaller contributions, her total super balance is 4.374,500. Now, what that basically means is when we take the calculation of the basic earnings, we have to subtract the 4.5, which is the starting balance, from the 4.374, and it gives us what they call transferable negative superannuation earnings of $125,000. So what we end up with there is we would still, in theory, be liable because we've got more than $3 million, but because our earnings are less than nil, we can carry those transferable negative earnings forward to offset against future years. So if in the year after Jan's balance goes back up, then we can offset that with that $120,000 worth of the earnings. Now, what I alluded to before with regards to, say, the startups and things like that is those earnings are all well and good. Those negative earnings are all well and good for those that are consistently going to be over that 3 million. So they're starting that period. But if you've got overinflated valuations and end up with a tax liability in 1 year, and then in future years, every year you're below $3 million after that point, then these negative earnings are somewhat pointless, and they do not carry through death. So they die with the member. So albeit that the pension moves from one member to the other, and therefore potentially the liability gets transferred to the next person, the losses don't. So it's another one of those areas that we certainly need to be mindful of in regards to how this tax is going to work. And that's a good little sort of segue into this death of the member concept that I wanted to talk about with you, because I generally I love a good argument / conversation about reversionary versus non-reversionary pensions, and I think there's a place for both and there's a purpose for both, but I think it's a conversation that is not necessarily about the pensioner as such, but it's about everybody else and what's appropriate in regards to the spouse and other beneficiaries with reference to superannuation, but also the fund's liability. But more importantly, it's actually also about timing, because we sort of fit into the idea of pensions are now governed by the transfer balance cap. And as such, we know that reversionary pensions get this 12-month grace where they're reported inside the normal timeframes from a reporting point of view, but they're not credited for 12 months following the date of death. So it gives us a lot of time from a planning point of view. In many respects, I think I think that's hugely beneficial in APRA funds where you don't have any control over the situation. Whereas a self-managed superannuation fund where the members are the trustees and the surviving trustee/member is often that recipient of the pension, I think you've got the scope to say, okay, well, we're in a better position by going with a discretionary pension because we don't have to pay the minimum this year. We still get the exempt current pension income. There's all sorts of things. But of course, in certain blended family situations, it may be best to have a certain amount fixed as a reversionary pension to ensure that current spouses get income needs and other things. So there's a whole estate planning piece around that argument anyhow. But I think if we look at it from a pure Div 296 point of view, what it does is it changes the timing from an assessment piece. So if we look at 30 June 2025 and we've got member A and member B with relatively similar balances, 1.7 and 1.9 million, and member B dies on the 7th of April 2026, right? And they die with a reversionary pension to A, and then there's $100,000 worth of pension payments. What happens is immediately, so on the 7th of April 2026, member A's total super balance basically goes up. So member A gets that $1.9 million added to them. Okay, so that's significant from a total super balance point of view. So that would cut them out of any capacity to make contributions and other things that would normally fall into line if they only had 1.8 million, for example, at 30 June 2026. They've then got to restructure before 7th of April 2027 from a personal transfer balance cap point of view. But if we look at it from a timeline of Div 296, so in the 25-26 year, we'll get the adjusted total super balance to incorporate the withdrawal amount and the pension commencement amount. So we're going to subtract that pension commencement off, which is going to give us an adjusted total super balance of 1.9 million, meaning there's not going to be any Div 296 assessment for member A that year. The following year, however, we've got the full 3.8 at the end of the year, roughly, again, looking at numbers, and all we're doing is adding back the pension amount. So we're going to end up with a Div 296 liability. So that's on top of any other sort of normal sets of circumstances that would apply around the considerations for what the clients are going to do. If we look at a discretionary pension situation, and this is where, again, I think people need to just be mindful of how it works. Same set of circumstances, except we don't have a reversionary pension in place. So member A, member B, similar balances. Member B dies on the 7th of April 2026, and they have their withdrawal amount. Now, firstly, that $100,000, whether it does or doesn't come out, is irrelevant in a non-reversionary pension. So your liability dies with you. So there's no obligation to pay the minimum in that year if it hasn't all been paid versus paying it out in a reversionary pension. The ECPI still applies, so the fund still gets the exempt current pension income deduction on the full amount until a decision is made. Now, what we do know is that the legislation requires that a payment in regards to the death benefit must be made as soon as practicable. Right? What we don't know, and by don't, I mean where we have a little bit of wriggle room, is that as soon as practicable is ultimately how long does it take you to make the decision to pay out a benefit for the surviving member. Now, that could be immediately, right? And then that's going to have consequences on starting new pensions and pro rata amounts and other sorts of things. But particularly when we're talking about somebody passing away in April, as soon as practicable can quite easily be in the next financial year. So if we say that member A starts a death benefit income stream on the 1st of July 2026, then at the 30th of June, their balance is only the $1.8 million which they had, and the 1.9 is still effectively sitting in the other member's account. The other member is not subject to Div 296 even if they had more than 3 million because they've died on a day other than the 30th of June. And then they look to start that pension, and then the combination of the existing benefit plus the new pension mean that at 30 June 2027, they're going to have more than the $3 million. What it ultimately does is it ultimately defers that liability by a further year. So under the reversionary pension system, they would have their first tax liability in the 26-27 year. Under the discretionary pension consideration, the tax liability would move because of the way you make the adjustments for the pension commencement and the withdrawals. The liability would move to the 27-28 year. So it really means that for our higher member balances, the whole concept of reversionary versus non-reversion, which I think is ultimately an estate planning consideration every year anyhow. Have your circumstances changed? Is this pension right for me still? I think it's something that, excuse me, from a planning point of view, I think more than contribution strategies, I think that the probably the most critical review that people do, in addition to the valuation element. So I think going back to Ryan's question before, I think the valuation is always going to be critical anyhow, but we're sort of restricted in how much we can move around with that based on what market value actually is and arm's length requirements, because we don't want to fall foul of any arm's length considerations. But this whole should we or shouldn't we have reversionary pensions is one that certainly I think will be a focus for the 24-25 year period for people to be mindful of. So let me sort of finish off by talking about some of the practical issues and then where to next with the legislation. So I think some of the key things is the total super balance changes. So that calculation is going to have slight impact, and certainly not from a $3 million point of view. It's not going to impact somebody with a carry forward unused concessional contribution, but the flow-on effect by changing the definition of total super balance will have impact on other strategies that we talk to clients about. And of course, the way that total super balance will be calculated for those with defined benefit interests is likely to change. So again, gives greater impetus to my comment before about making adjustments for the or legacy pensions and potentially having that legacy pension amnesty introduced sooner rather than later, so that people can work almost exclusively on an account-based pension basis to know what balances are. So I think that's a key issue there. And then the tax affecting accounting and exit costs. And I think tax effective accounting is something that the majority of people that I'm aware of in this industry already utilize tax effective accounting, but incorporating exit costs associated with the sell down of assets, that's probably an area that I think people will view, if they're not already doing it from a total super balance and transfer balance cap point of view. But then also what further reporting obligations are going to be placed on funds. So will we be required with those defined benefit interests to provide valuations each year? Will it differ from the current situation? What changes might apply with regards to contributions and withdrawal amounts as such, and incorporating things like insurance. So will there be changes to the annual return? How will all of that be reflected? So I think there's a bit to go down in that path. So where to from here? We'll ultimately, we're in a situation where the government don't seem to be too keen to consult too much on it. However, as I said, it has been referred to a Senate committee, and they'll be reporting back in April, I think is the time. And so that image on the side of the slide there just sort of highlights that if the government, if the opposition, for example, are opposed to this measure, then they have to potentially convince some of the independents or minor parties. And if the government want to see it flow through in its entirety, then they have to convince the independents and minor parties. So there is scope for the industry to I guess have a crack at the senators via Senate hearings to try and implement some of the changes that some of the issues that I've highlighted today, but the industry have also been highlighting throughout, primarily around obviously the unrealised gains is the big one there. So there's a fair bit to still happen. We won't see anything really until after April. So keep your eye out for what comes from that point onwards. So thank you for attending today. Just to wrap up, we've got, so from the webinars that I provide with regards to SuperGuardian, we've got next one in March, which I'm going to talk about indexation and how that impacts clients. So, we're likely to see an indexation of concessional contribution cap, which means the NCC cap. There's no indexation of the transfer balance cap, but there's a lot of other things like pension age moving to 67, preservation age moving to 60. A lot of impact items that come into effect in the 2024 calendar year. So it's a good opportunity to talk about that. And then in April, I'm going to talk a little bit about winding up and the processes, because a lot of clients start to look at 30 June if they're keen to wind up their fund, and obviously the later in the financial year you look at it, the harder it gets to wind up. The other point there that I just wanted to make a mention on, obviously, with the work that I do here at Smarter SMSF, we have our SMSF Day. For anyone interested in that, we are talking a lot about Div 296, the gnarly changes, and estate planning. So it will have 8 CPD hours. SuperGuardian are one of our supporters for the day, so we're always very thankful to our supporters for being involved with that. And we have basically a roadshow: Adelaide, Perth, Brisbane, Sydney, Melbourne, and tickets are limited, but by all means you can jump on our site if you're interested in attending that event. But it's a good day just listening to myself and Aaron talk about a number of these key issues in a real practical sense, and getting you to do a bit of work as well. So look, thanks again for attending. I hope you got something out of today's session. As always, you'll get SuperGuardian will send through the CPD and a copy of the presentation. So that'll come through later this week with a copy of or a link to the recording as well, if you want to go back and check in on anything. But thank you all for joining me, and I look forward to catching up with you all at the March event when I talk about indexation. Okay, thanks very much, everyone.